And just to repeat, for those of you joining now, there is a Q&A button down the bottom of the screen for those of you joining on Zoom. And so you can add the questions as we go, and we'll try and answer them in the relevant part of the presentation as we go through. So please go ahead and add your questions. Don't need to wait until the end. Okay, we've still got people joining, so we'll just give it another minute. Yes, there will be recordings available for this session. Okay, let's get started. So, morning everyone. I'm John Casey. I'm the Managing Director here at Virtuzone of the accounting and tax part of the business. This is sort of the latest in a series of webinars that we've been holding. We haven't really had any updates since the last webinar. So for those of you that joined the last one, there hasn't really been any significant announcements. So we'll be sort of rehashing, going through the basics for the most part. So again, for those of you that have just joined, at the bottom of the screen there is a Q&A button. You can just add the questions as we go. I'll try and answer them in the relevant part of the presentation. So please, don't feel like you need to wait until the end for questions. Just send them through as they pop up. Okay, I will share my screen. We'll go through some slides. Just one moment for that to load up. There we go. Okay, so the things that we will cover today. So we've spoken to around 1,000 businesses in the last sort of 6 or 7 months. The most common questions we get are still, there's a bit of misunderstanding around who is actually, falls under corporate tax. Those that it does affect, when does it come into effect? What do they need to do? And then obviously the big question around, will I actually have to pay any tax? Am I exempt? If I am exempt, what do I still need to do? So we'll go through all of that today. But the biggest question that we are still getting is, does it affect me? So who is taxable? Look, there is a very easy rule to remember around this. So every single company in the UAE falls under corporate tax. Okay, it doesn't matter if you are in a free zone, if you are, under the taxable threshold. People talk about 375,000 dirhams. None of that matters in terms of the compliance steps that you have to go through. So there is still a huge misunderstanding around this. So people still think that if all of their revenues from outside the UAE, then they don't have to do anything. Not true. So you might not have to pay tax, but you still have to go through all of the compliance steps, right? So when we say, okay, who is taxable? Every single company is, in theory, taxable, and you need to prove if that's not the case. You need to prove if you're not going to be paying tax. I guarantee you there are still people out there who, think that they don't have to do anything because they're in a free zone or something like that. But unfortunately, no, every single company is taxable in the UAE. I like to contrast it to VAT, right? So VAT, people, you sort of opt in once you become a taxable business. So once you hit a threshold or once you make certain supplies, then you opt into VAT. Corporate tax is the complete opposite. So you are, by default, you are a taxpayer and you have to go through, you have to submit the returns and everything. And you have to prove, you kind of have to opt out if you are not a tax, if you don't have to pay tax. So we'll go through what the mandatory steps are, those mandatory steps for every company. But in terms of what we are going through, every single company needs to, do the compliance steps. There is an exception. You'll notice that I'm using the word company and not business. So there is a special rule for what's called natural persons. So if you are a freelancer, or if you have a special type of license, sole trader license, you only have to register if your revenue gets up to 1 million dirhams, right? But for everyone else, you have to, this applies, regardless of your revenue, even if, you make no revenue at all, you still have to register. So if you're registered in a free zone with any kind of company, then, it doesn't matter. Even those companies that are just there for visa purposes and don't earn any revenue, you still need to go through the process of registering, filing tax returns and everything. Okay. So just a reminder, that 1 million dirham threshold that I referred to, basically it's just freelancers and a few other types of individual businesses. The technical way to look at it is if there's no separate entity from the person, right? But for every company, by default, if you have a company, if you have a free zone company, then corporate tax applies to you. So you just you just ignore that 1 million dirham threshold. Okay. So now that we've established that every company is taxable, you need to think about, when did it actually kick in for you? Basically 99% of companies in the UAE tax came into effect on the 1st of January. So the compliance steps that we're about to go through, you should already have in place, especially the accounting. But there's an easy sort of rule to follow around this. So if your company was formed before the 1st of June 2023, right, then you became taxable on the 1st of January 2024. Okay. So, if your company is a couple of years old, or you formed it in the first half or early last year, then tax comes into effect for you on the 1st of January 2024. For any company that was, registered or formed after the 1st of June 2023, all right, so you formed it in the second half of last year, tax actually applied to you from the formation date. I know that sounds a bit counterintuitive because a company that was formed later, tax comes into effect earlier, but basically the rules are it comes into effect for your financial year that started after the 1st of June 2023. So if you formed your business, in the second half of 2023 after June, your first financial year started when you started the business. So you became taxable. Basically, your business was formed into a live tax environment. So you were taxable straight away. But for any companies that were formed, in 2022 or earlier, or in the first half of 2023, everything kicked in for you from the 1st of January 2024. So you're about 6 weeks or 7 weeks into the tax regime now. There is one exception to those rules, right? For those of you registered in Dubai World Trade Center, DWTC, DWTC follows a slightly different rule for their financial years. So if you are a DWTC company, you need to check your memorandum of association. That will tell you when your financial years run. And basically, if your financial years run from June or July, August, September, October, November, December, basically June onwards, that's the start month, then you're taxable from last year. If it starts in the first half of the year, you're taxable from this year. I know that's a bit complex. If you are a Dubai, a DWTC company, maybe best to reach out to me separately because it's a little bit more complex. But that's just for DWTC clients, Dubai World Trade Center companies. For everybody else, the default tax year or default financial year runs January, December. And it's only different if you started your company in the second half of last year. I hope that makes sense. Like I said, 99% of you will have been taxable from the 1st of January this year. So, basically everyone is taxable anyway right now. So the compliance steps that we're about to go through you should really have in place already. Okay. The compliance steps. So this is what every company has to do. Okay, so we've established that every company is taxable, falls under the tax regime. We know that we now know the start date, right? And so what we know also is that every company must do at least these three things, right? So the first thing they need to do, well, first of three things they need to do is they need to be registered for corporate tax. Okay, so you don't get registered by default for corporate tax. You actually have to go through a process of registering your company with the Federal Tax Authority. Just like VAT, if you don't do this, there are fines in place. The deadline sort of varies depending on the financial year, but basically there's no benefit in holding off your registration. Every company has to do this, so it's sort of one of the initial steps that you have to do. Register yourself with the FTA. Now, most accounting providers, ourselves especially, we do this for free as part of the accounting service here. But it is, it's something that is mandatory for every company. Okay, the biggest thing that you have to do is keeping proper accounting records. Now, this is what you should have had in place from the 1st of January 2024. All right. This is where the most sort of complexity for small, for SMEs, for small businesses, this is where this will come about. So we'll go through the rules around accounting records on the next slide, but every company, you need to be making sure that you're keeping accurate accounting records to the correct accounting standard. Now, the general accounting standard in use is International Financial Reporting Standards, IFRS. So you can't just be doing this, on the back of an Excel sheet or on your bank accounts. We'll go through the fines on the next slide, but this is really where the biggest compliance step is, right? That is mandatory for every single company. There's no real exceptions for this. And there is a lot of expectation from the FTA that every company is going to be doing this. Okay, and then the final step will be filing a corporate tax return. Again, you have to do these steps regardless of your level of turnover, regardless of whether you're exempt from paying tax. You can't just sit back and do nothing and assume that the FTA will come knocking on your door when it's time to do something. The first thing the FTA will do, so if you sit back and do nothing, the first thing the FTA will do, you'll be getting the fines for not registering, for not submitting your tax return on time, and then the fines accumulate every month beyond that. But the biggest ones are around the accounting records. You'll see here there is an additional step for companies that are going for a free zone exemption. We'll go through that exemption a bit later on, but they will also need to do an audit. The only other audit requirement outside of the free zone exemption are companies that are earning more than 50 million dirhams of revenue per year. So look, these are the basics that every company has to go through. Okay, so we know that every company has to do this because corporate tax applies to every company. We know the dates now that you have to have started this. 99% of companies should have started this already. And we know the steps that you have to go through, right? So you need to register, you need to file, you need to keep proper accounting records, and you'll need to file a tax return. Even if that is a nil return showing that you don't have to pay tax, you still have to go through and be compliant and file that return. Okay, accounting requirements. Now, this is where we see some of the most significant fines. To give a bit of context to this, you'll see later on in the presentation that there are some very generous exemptions and thresholds available to businesses, especially small businesses. All that the FTA is asking in return is that you are keeping your accounting records accurate, okay? Because if they are allowing these thresholds and these exemptions, they want to make sure that if you are applying for one of them, that you have actually, you are genuinely eligible, right? So the way that you prove that is by making sure that you have accurate accounting records done to the correct financial standard. So you'll see here that depending on the size of your business, you may apply, one of three different variations of IFRS, International Financial Reporting Standards. regardless of which one applies to you, you still have to produce the profit and loss account. You need to be able to show that your revenue is recorded correctly. And you'll need to file your tax return on the basis of these set of accounts. As I mentioned, the penalties are really significant for this, right? Because this is the core to the whole tax regime, is proper accounting records. So if you don't keep proper accounting records, right, the FTA will fine you straight away 10,000 dirhams. If you cannot correct your accounting records, then that fine goes up to 20,000 dirham. Contrast this with the fines for not registering and not filing a tax return, which are between 5,000 to 10,000 dirhams. Right, so this is where the FTA has a real sort of high expectation of the companies in the UAE to adhere to the corporate tax rules. So look, if you're sitting here and you're thinking, oh, look, I haven't actually done any of this, it's still not too late. You can start, you can still sort of backdate your accounting back to the start of January quite easily at this point. The later that you leave it, the harder it is to try and backdate your accounting, because the best case is you're just missing a few receipts, so you have to misclassify expenses. The worst case if you left it till the end of the year and you don't know what you don't have memory of what transactions related to, or you can't find the support for what they're related to. The worst case is you end up either with fines, or you miss out on an exemption because you can't accurately classify your transactions, or you end up paying more tax than you should. It's really, there's no benefit in waiting until the end of the year for this. You're probably going to have to pay more for accounting if you wait until the end of the year, because it's going to take more time. By far the best approach is just get on top of it now and get things moving. Okay, I've got a question, a few questions coming through. So my company established in April 2022. So first declaration will be from January to June 2024 for the FY of 2023. Okay, so for a company that established in 2022, I'm assuming that it's not in DWTC, right? So just a normal, one of the other free zones or mainland. If you establish in April 2022, okay, it's a mainland company. So April 2022, your first financial year ran from April 2022 to December 2022. Your next financial year ran January 2023 to December 2023. And then your next financial year goes, so basically you go January to December from then on. So you went April 22 to December 22, sorry. Jan 23 to December 2023, Jan 24 to December 2024, Jan 25, December 25. Your first taxable year is the 2024 tax year. So tax came into effect 1st of June 2023, okay? Because you started your financial year in January 2023, you had already started that financial year, so that before tax came in. So that financial year is not taxable. Right? It's only the one that starts after the 1st of June 2023. So your first tax year goes 1st of Jan 24 to 31 December 24. I hope that clarifies. Okay. So, and in terms of, sorry, there was just a question there around deadline for filing a tax return. So for 99% of companies, your first tax year runs January 24 to December 24, and then you file your tax return in the start of 2025. You have a few months to do that, 9 months actually. But yeah, obviously you can't file a tax return during that actual year, because you need to include all of your accounting for the full year. So once you get to the 31st of December 2024, after that date, you can file your 2024 tax return. So start of 25. Okay, the biggest question, will I pay tax? So we'll talk about this from the perspective of a free zone company. Okay, so there are basically 4 layers that a free zone company needs to fall through before it will be paying any tax. Okay, so the first criteria that it looks at is the qualifying free zone exemption. Okay, now there are 2 criteria or 2 categories by which you can qualify for this exemption, right? Or to get over the big first hurdle. And the big hurdle looks at the source of your revenue. Okay, so the first category looks at the geography of your clients. Okay, so if you are a free zone company and all of your revenue, or 95% or more of your revenue, is coming from other free zone companies, then you meet the first hurdle for what's called qualifying income. Okay, so you're a free zone company, but you only have clients in the other clients who are other free zone companies, then you basically exist in the free zone bubble. It doesn't have to be your own free zone. It can be across multiple free zones. But as long as you are just doing business inside the free zone bubble, right, UAE free zone bubble, then you'll meet the qualifying income criteria. Or you should meet the qualifying income criteria. Let's say that you don't meet that criteria. Okay, so you're a free zone company, but you are getting revenue from outside the UAE and also from the mainland. Okay, so that will disqualify you from that geography test. Just a point of note here, you'll notice that I said revenue from outside the UAE. That is not exempt, right? If you are a free zone company and your revenue is all coming from outside the UAE, that does not guarantee, that does not automatically become exempt. Okay, there's a little bit of confusion there because in some original documentation, it was implied that a free zone company that was only getting revenue outside the UAE would be exempt. Unfortunately, that's not the case. There are still exemptions available for that sort of business, but it is not an automatic exemption. Okay, so first category we looked at is the geography. So free zone company only doing business within the free zone bubble, then you're likely that you'll hit the qualifying income hurdle. The next category to look at are activities. All right, so let's say you are a company in a free zone, but you are doing business outside the free zone bubble, so outside the UAE and on the mainland. You can still meet the qualifying income criteria, but only if you're doing what's called a qualifying activity. Now, there is a list of qualifying activities, which we've got on subsequent pages. We'll go through it. I won't go through it in too much detail because it's about 13 or 14 items. But the qualifying activities are very much focused around heavy industry and sort of financial and wealth management, financial investments. As a general rule, services are not included in the qualifying activities. So things like marketing services or IT consultancy, those aren't a qualifying activity. It's very much things like trading in aircraft or aircraft parts, or shipping businesses, or manufacturing, or logistics. There are a couple of specific examples which I'll go through separately, but as a general rule, if you are doing a service-based business such as marketing or IT consultancy, then you won't meet the qualifying activity criteria. So let's run through an example, right? So let's say you are a IT consultancy. Your business is set up in a free zone. Okay. Your clients are all outside the UAE, right? So what that means is your clients are outside the UAE, so you're not doing business in the free zone bubble, so you don't meet the geography criteria. You're doing a IT consultancy, so you don't meet the qualifying activities criteria, right? So that means you've missed out on the qualifying free zone exemption. Okay, so in that situation, we look at the next layer, which is called small business relief. Now, this is available to all companies, free zone companies and mainland companies. And this rule just says if your revenue is less than 3 million, your annual revenue is less than 3 million dirhams, then you're exempt from paying tax. Okay. Remember, you still have to go through all, regardless of which of these criteria you meet, you still have to go through all the compliance steps. So you still need to register, do proper accounting records, and file a tax return. But if your revenue is less than 3 million dirhams, you won't have to actually pay any corporate tax. This rule is in place just for 3 years. It's basically a soft introduction for small businesses. So 2024, 25, and 26, this rule is available. So if your revenue in each of those years is less than 3 million, so under 3 million in 24, under 3 million in 25, and under 3 million in 2026, then in each of those years, you won't be paying any corporate tax. You don't require an audit for this rule. However, because it only goes for 3 years, there is actually a preference, if you qualify for the free zone exemption, you want to go for the free zone exemption because that is, that goes for longer. Okay, so, if you are, let's use that the IT consultancy example. So you're an IT consultancy, you have clients outside the UAE, right? We know that you don't meet the geography criteria, you're not a qualifying activity, but, and so you miss out on the free zone exemption. But if your revenue is less than 3 million dirhams, then you won't have to pay tax. You'll just have to file, with your accounts to show that your revenue is being recorded correctly, and that revenue is less than 3 million, so you won't have to pay any tax. Okay. Using that same example, let's go through all the way through to the next layer. Okay, so IT consultancy, clients outside the UAE. We know that you don't meet the free zone exemption. Let's say your revenue is 3.5 million or 4 million dirhams, right? So in that case, you don't get the small business relief either. And so that means that you are a taxable business. Okay, so if your revenue is more than 3 million, you don't have the free zone exemption, what happens is the FTA stops looking at your revenue and they start looking at your profit. Okay, so this is where you take your revenue, you take off your expenses, what's left is your profit. Now, the first 375,000 dirhams of profit is taxed at 0%, so it's tax-free. And then any remaining profit or any profit above 375,000 is taxed at 9%. So using that same example of an IT consultancy, right? So we know with clients outside the UAE, revenue of 4 million. So we know because of your activities and your client location, you don't meet the free zone exemption. We know that your revenue is 4 million, so you don't get the small business relief. And let's say that your profit after your expenses is 1 million dirhams, okay? So you're over the tax-free threshold. What that would mean is you pay 0% on the first 375,000 dirhams of profit. And then that leaves you with 625,000 dirhams of profit, what's left in your million dirhams. So you'd only be paying the 9% on the 625,000 dirhams, which is around, 60-odd thousand dirhams of tax. So a few questions coming in around this. Do tax-exempt companies have to meet accounting standards? Yes, absolutely. So the only way you can get one of these exemptions is by supporting it with proper accounting records. You can't just sit back and say to the FTA, hey, trust me, I'm under the threshold. You've got to prove it, and you've got to prove that your accounting was done, to the correct accounting standard. Sorry, just one moment. Sorry, just a second. Okay. Sorry, I just lost a power cord. Okay, so another question here. If we're a free zone company running IT consultancies within the free zone bubble, so I've sort of run through the criteria there in order, right? So if you're a free zone company just going within the free zone bubble, then you'll meet, you should meet the qualifying free zone criteria. and you'll be, you should qualify for that exemption. Now, sorry, we'll just pause there for a second. There's just a little IT issue. Hang on a second. Bear with me. Charger. My thing's about to die. Yeah. Sorry, I've just realized the charger is not working. Okay. And another question here, free zone company, do they have to go through all of the compliance steps? Yes, absolutely. So the only way you can qualify for a free zone exemption is by going through all of these steps. And also, you actually also have to do an audit. So to do the free zone exemption, you actually have to get an auditor to sign off on your accounts as well. Okay. Oh. Sorry about that, everyone. Looks like the charger is working now. It looks like we've still got everyone here. So we shall resume. I'll jump back to the presentation. Apologies again for that. Okay, so the question here. So a free zone company running an IT consultancy service within the free zone bubble, but revenue over 3 million. So basically the layers that I ran through were in order, right? So if you are just doing business, and it needs to be B2B, right? It needs to be from other companies. You're just doing business within the free zone. That is the first criteria, right? So you don't have to look at the other layers. Okay, so you meet the free zone criteria for qualifying income. You don't have to go any further and look at any of those other ones. Basically, you'll be filing on that basis. It's only if you don't meet that criteria that you fall through to the next one and you look at the next one. If you don't meet that one, then you go through to the next one, right? So, so in your case, if you are just doing IT consultancy and it's B2B within the free zone bubble, then you'll meet the qualifying income criteria. There are a couple of other hoops you need to jump through for the free zone exemption, which we'll go through in a second. But if you are doing that, then you don't need to look at the other criteria to go through. So the 3 million is almost a moot point because it's you're not going to even go down to that level. Question here about the tax-free threshold. Maybe I'll just explain that again. Okay, so let's say that you fall through all of those layers, right? So you're doing business outside the free zone, so you're not getting the geography test, you're not doing the qualifying income. You're not doing a qualifying activity, right? So let's use the example of IT consultancy. So IT consultancy doing business outside the free zone. If your revenue is more than 3 million, right, then you don't get the small business relief. So you've fallen through all of those layers. And so now they look at your profit and they decide, and you pay tax on your profit, but you only pay tax on your profits, which are over 375,000 dirhams. So using the example of a company which has 1 million dirhams of profit, okay, they're only paying tax on 625,000 dirhams because 375 of the million is tax-free, right? The first 375. And then you're paying tax on the remaining 625. So you're paying 9% on the 625,000. If you had 2 million of profit, you'd be paying tax on 1.625 million because the first 375,000 would be tax-free. And just a reminder, even if your profits are under 375, so let's say that you had revenue of 5 million, but your profit was only 250,000, you still have to file the tax return. You still have to go through all the compliance steps to prove, that that you don't have any tax to pay. Okay. let's go into a bit more detail on the free zone exemptions. So I've mentioned, 95% of revenue, or when I say all of your revenue should be coming from free zone companies, it actually only has to be 95%. They allow you up to 5% of non-qualifying income. So, if you earn some interest on a term deposit for your business, that's not going to disqualify you from the free zone exemption, right? But if that term deposit interest is more than 5% of your revenue, then you're probably going to lose it. So basically, they know that, it's not going to be perfect. They only say 95% of your revenue needs to be that qualifying income. When I say qualifying income, I mean the criteria that we spoke about, which is from other free zone companies or from one of the qualifying activities. Now, I won't go into qualifying intellectual property because that's a little bit complex and is linked to how much you spend. If you think that, if you have a really high spend on IP assets, then it's worthwhile chatting to me separately because that's a bit of a complex one. However, the other big hurdle that you need to jump through for the free zone exemption is around substance. Okay, so let's say that you meet one of the qualifying income criteria. So either you're just doing business within the free zone or you're doing a qualifying activity, right? What you also have to do is you need to show economic substance in the free zone. So what this is basically you need to show that you're actually running the business, from the UAE, from that free zone. Okay, this rule is here to prevent people from basically creating shell companies in a free zone, putting revenue through there, purely for the purpose of tax avoidance. You need to actually show that you're running a real business from the free zone. For those of you that, that is the only company that you have, for example, if it's just the free zone company, this should be pretty straightforward because that's, the only business that there is. However, if you have other companies that are doing intercompany transactions with that free zone company, or, you don't actually have any employees in the company or no one's actually doing any work there, that can raise a few red flags about the free zone substance. But, in most cases, we find, people they've got their free zone company, they're actually running the business here in the UAE. And so the substance the substance hurdle won't be an issue. All right. I mentioned qualifying activities. Didn't want to go into too much detail about them, but here is the list. As you'll see, this is very much heavy industry based, manufacturing, financing, leasing, logistics. There is one activity in here that I'm going to go through in a bit more detail because we are finding more and more clients that actually fall into this criteria, only under certain circumstances. Now, there was a question earlier on about this. So there's a rule here. Well, one of the qualifying activities is called distribution of goods or materials in or from a designated zone. Okay. There are a couple of elements to this. So the first thing to remember for this is that the client or the end customer whoever you are selling to, it needs to be a further distributor, a further retailer. So it needs to be B2B. This can't be B2C. Okay. That's the one rule to just remember as we go through this. The second rule is that this only applies to designated free zones. So if you are in a free zone like DMCC or Maidan or Shams, this doesn't apply to you because you are in a standard free zone. This only applies to companies that are in designated zones. Okay. Now, what this rule says is that if you are a designated zone company and you are basically operating what's commonly called a dropship model or a e-commerce, basically you are buying from a supplier in country A and selling to a client, a customer in country B, and that customer again is a B2B, you'll be exempt from corporate tax. Okay, so if that's still, even if the goods don't enter the UAE, right? So ship direct from country A to country B. You'll be exempt from corporate tax if you are registered in a designated zone. For those of you not aware what a designated zone is, they're basically customs bonded zones. So think of JAFSA. There are certain areas up in RAC. So they're normally sort of the port zones. The Dubai Airport Free Zone, for example, or economic zone is a designated zone. It's where, you know, goods, unless goods leave that designated zone, they are not deemed to have entered the UAE. So the most common one is you know, the most well-known one is JAFSA. If you think about it, if you go down to JAFSA, you need to, you know, show ID to get through the gates and things. Basically, it's a you know, it's a bonded customs zone. And so if your company is registered in a designated zone, then you know, and you do these activities or this type of activity, then you'll be exempt from corporate tax. Now, this rule also applies if the goods are coming into the UAE. So let's say you have a designated zone company, you have a warehouse in the designated zone. The goods come into the UAE, you store them in the warehouse, and then you ship them out to to country B. That still qualifies for the exemption. But also, which is, and this next one's quite significant, if you are distributing the goods into the UAE from your designated zone company, that is also exempt. So let's say you import from country A into your designated zone company, and then you sell the goods from your designated zone company to a UAE mainland company or a UAE standard free zone company or a designated zone company, then that income will be exempt or qualifying income. Again, you know, this is only for designated zone companies. So the next big question that lots of people are coming to us to here at Virtuzone, a lot of people are coming to us about is, you know, moving to a designated zone. So, you know, there are a lot of the free zones are across this. You know, we work very closely with a lot of the free zones. You know, and a lot of companies are either shutting down and reopening in a designated zone, or a new company opening in a designated zone. Or in the case of, you know, up in Ras Al Khaimah, for example, they have both free zone and designated zone, and companies are able to move across to the designated zone. So a question here, you know, the distribution company and DSO. So again, you know, this person who's asked the question is aware that this, you know, they will be exempt based on their activities if they are in a designated zone. Silicon Oasis is not a designated zone, so they are looking to move. Yes, it's something you can do. It's a little bit complex if you do a pure sort of try to actually migrate, especially from Silicon Oasis. But it is something that can be done. So Ajmal, if you want to maybe chat to us afterwards, I'll put a link at the end of this, where you can basically just jump on and chat to one of my team who can walk you through the process about, you know, the migration and the exemptions and how to get them. Okay. Sorry, just before I move forward, there's another question here, a freelancer license. So if you're a freelancer license, you only need to, corporate tax only applies to you if your annual revenue is over $1 million dirhams. If your annual revenue is over $1 million dirhams, then basically this applies, you know, all of the compliance steps apply to you. Okay, just quickly on small business relief. So as we've discussed, you know, it's turnover up to 3 million. It's a black and white threshold. So if you go over 3, you know, if you're 2.99999, then you're exempt. But if you hit the 3 million of revenue, then you are a fully taxable business. You don't get a first 3 million exempt or anything like that. It's black or white. So you're either in the exemption or you're out. It's only available 2024, 25, and 26, right? And then in 2027, you'll become a taxable business. Doesn't require an audit, and it's available to all companies. Now, just a reminder, because this is only available for 24, 25, and 26, the free zone exemption is available basically as long as the free zones are in existence. So if you can qualify for the free zone exemption, you always want to go for that over the small business relief, because if you don't qualify for the free zone exemption, or you opt out of the free zone exemption, you can't actually go back in for 5 years, right? So there might be a temptation to go for small business relief because it doesn't require an audit, but the free zone exemption does, right? But don't be tempted by that, because by staying with the free zone exemption, you'll save tax in the long run, because in 2027 and 2028 and 2029, beyond 2026, if you're in the free zone exemption, you'll still be exempt. But if you go for small business relief, you can't jump back into the free zone exemption until 2028, 29. Sorry, 2029. Okay, so if you're a taxable business, right? So let's say you don't meet the free zone exemption, your revenue is more than 3 million, right? Then we're looking at your profit. And in this case, we are looking at the same games that we play all over the world about minimizing your taxable profit, obviously, legally within the parameters of the tax regime. Now, one of the most common questions that I get from companies is around owners being able to pay themselves a salary. Now, again, this is only relevant, right, if your revenue is over 3 million dirhams. So I have a lot of clients come to me first, and the first question is, well, can I just pay myself a big salary? I'm the owner. But actually the revenue is, 2 million or a million. So it doesn't even matter, right? They're not going to be paying tax at least until 2027. So so this is only really relevant right now if your revenue is over 3 million dirhams. Or, if you're looking ahead to 2027, what do you have to have in place when you become a taxable business in 2027? So there are two elements to an owner paying themselves a salary, okay? And we don't have entire clarity on the first one, but we do have a bit of clarity on the second. So the first element is from a compliance standpoint and a visa standpoint, is the owner entitled to take a salary out of the business? Okay, so what we see in Saudi Arabia with the tax regime there is that your salary is only a deductible expense if you are actually listed as an employee of the company. Okay, so what that would look like over here is if you are the owner of the company and you're on an investor visa and you're not actually an employee of the company, you're just a director, you are not listed as an employee of the company. So if you're not an employee of the company, you're not entitled to pull out a salary, right? You are entitled to pull out a dividend, but a dividend is not tax deductible. A dividend is paid after tax, right? So, your profits, you pay your tax, and whatever's left, you pay your dividend out of that, versus a salary, which is paid out to an employee of the company. Now, an owner can be a employee, but they need to be, they need to convert themselves over, to an executive director role or, employee role, an enlisted employee of the company. So that's the compliance side of things. So do you have the correct, compliance set up, the correct visa set up? Are you, from a regulation perspective, are you entitled to take a salary out of the business? The second element is, okay, how much can you actually pay yourself as a salary? And this is where we go to something called the connected person rules. So a connected person is, a shareholder, a director, their spouse, their children, their niece, their nephews, their grandchildren, all the way down to fourth degree of kinship. So I think that's great niece or nephew. Anyone in that group is considered a connected person. And the rules around connected persons is that any transactions with that person need to be at market value, or what's called arm's length. Okay, so when it comes to an owner paying themselves a salary, the benchmark is, all right, well, if that person went and got that same role for an unrelated company, so just, went out on the open market and got that same role somewhere else, how much would that person get paid? Right? And if that's 30,000 dirham a month, then that's the benchmark of what the owner should be paying themselves, 30,000 dirham. I know that this becomes very, very difficult. If it's a very successful business, right, and there's only 5 employees, right, what can the owner actually pay themselves? And this is where you sort of need to go into a bit of a benchmarking exercise. The big one we have is management consulting. So a lot of management consulting clients, it's a 1 or 2 person organization, high revenue. And, we are looking at, all right, well, what does a partner in a management consultancy earn? And sort of benchmarking off that. So the two elements, A, are you, in the correct position from a visa and compliance perspective to actually withdraw a salary? And part two is, what amount should that salary be? It should be market value. It should correspond to what you would earn in an unrelated business. Right, and just a reminder, the reason that you want a salary instead of a dividend is that a salary gets paid before tax, so it is a deductible expense, whereas a dividend, which is what an owner can take out as, after tax, that out of profits, that is paid after tax. There's a question here, remuneration, is there any limit? Yeah, so that's what I've just been explaining. So the limit on the remuneration, on the salary, is, the market value of what that salary. So, if you want to employ, your son or your daughter to come and work in the business, you can't just go and pay them $1 million dirhams a month to clear out the profit. If you need to pay them a corresponding amount to what that, what that role would really be earning if it was in an unrelated business. There's a question here. Okay, so if an owner is listed as an employee of the company and the salary and commissions exceeds the natural person corporate tax limit of $1 million dirhams a year, will they be liable for corporate tax? No. So, so natural persons, right? The $1 million dirham limit only applies to actual business activities. Okay, so it excludes salaries, it excludes commissions, bonuses, it excludes trading in shares and dividends, and it excludes real estate investments. Okay, so there is no personal income tax, right? The only reason that a natural person would have to register for corporate tax is if they are running a business. Now, you should only be doing that in the UAE if you have a license to do that. So generally speaking, you would have a freelancer license. But let's use the case where someone has a freelancer license, but they also work as an employee of a company, okay? You only look at the revenue coming from the freelancer license activity, right? When you're looking at that $1 million dirhams. So let's say Anastasia has using a random name as an example. Anastasia has a freelancer license, but she also works as a consultant for a management consultancy company as an employee. Let's say her income from the management consultancy employment is 1.1 million dirhams, right? And her income from her freelance activity, let's say that she sells gift cards online. Her revenue from the gift card business is 200,000 dirhams, okay? So remember, she's a freelancer license, she's an individual. Her total income is, say, I think I said 1.2 from management, so 1.4, but she doesn't have to register for corporate tax because the activities on her freelancer license, which is selling the gift cards, is only 200,000. If that went up to $1 million, so she was selling $1 million dirhams worth of gift cards, then she would have to register for corporate tax. But salaries, personal investments, including real estate, including shares, are not taxable. Sorry, another question here. Not clear corporate tax. We have to calculate before owner remuneration or after. Okay, so so if you are an owner, right, and you are an employee of the company and you are taking a salary, which is market value, then you can deduct that off your revenue, right, as an expense. And what's left is the profit, and that's what gets, as well as your other expenses. The profit is what your tax is calculated on. After you've paid your taxes, whatever profit is left, then you can pay, then you pay dividends out of that. Natalia, sorry, that's the same question. So if you're a freelancer license, you only need to, corporate tax only applies to you if your annual income, your annual revenue, sales, is over $1 million dirhams. So I'd recommend that you still keep financial records to measure whether you go near to that $1 million dirhams. And if you hit that $1 million dirhams, then you have to go through all of the compliance steps the same as a normal company. So I think we've got the compliance steps here. So if you're a freelancer business and your revenue hits 1 million dirhams, you have to go through registration, accounting, and file a tax return. If your revenue goes over 3 million dirhams, then over 3 million dirhams, sorry, then you won't get small business relief and you'll be paying tax. Okay, I just jumped over a slide here. Just one thing I want to quickly cover. So we have people that are looking at, we have a lot of people asking, well, I'm closing down some previous businesses. I'm just going to continue with one. So if you close down your company past the 1st of January, right, this year, so basically if you're planning to close down a company, even if you haven't had any income, you'll still need to go through the steps, right? Because you're taxable from the 1st of January. So you need to prove that you didn't actually make huge, if you didn't make huge profits from January to now, you need to submit a file, before you can actually get a clearance, right? Until you're actually clear, before you are clear, sorry, you need to register for corporate tax, file a tax return for the taxable period, 1st of January 2024 to now, pay any tax if it's due, and then you'll deregister. Okay, just a reminder on the compliance steps. So every single company, regardless of which one you qualify for, you need to go through these steps. It doesn't matter if you're exempt, if you're under the threshold, if you're in a free zone, you still have to go through these steps, okay? The only exception is the freelancers, right? And then it only applies when you're at 1 million dirhams. But every other company, you have to go through this. Okay. So, obviously, we here at Virtuzone, we specialize in providing services to the small and micro and medium sized businesses, startups as well. We have very, very affordable pricing. We've done benchmarking exercises in the market to make sure that we are, at very much at the affordable end. We do monthly payments at the moment to help with cash flow. If you're a tiny business and you're just here or you just have a business for visa purposes, for example, it's a very minimal payment per month to be fully compliant and make sure that, you're not going to get hit with those huge fines. First step to go, to take advantage of these, just go to taxready.ae. On taxready.ae, you can book a session with one of our advisors. It's a free call, 15 minutes. They'll run through your business, work out what you need to do. And obviously we would hope that you take advantage of one of our very affordable packages that covers you for the whole year. But it's really a case of making sure that you are aware of exactly what you need to do. So it's tax ready, so taxready.ae, taxready.ae. You can just book a call on there. So please, if you're still not sure about what you need to do, just jump on there, book a call. It's free, it's absolutely free. And the team will talk you through what you need to do. Really the main thing is get onto it now. Don't wait until later on because it just gets harder and harder as the year goes on. Sorry, I'm getting asked about the question. Sorry, the address. It's tax ready. So as in you're ready for tax. So taxready.ae, ready.ae, taxready.ae. There we go. We got it. Okay, so thank you, everyone. I really hope that was helpful. I think hopefully I illustrated that whilst, yes, this applies to every business, not every, there are many, many companies that won't actually have to pay tax. The main thing is, you've got to get on and you've got to actually prove it to the FTA if you're not paying tax. And you do that by going through the compliance steps. The biggest one, just like everywhere else in the world, is that you've got to do your accounting. So thank you. We'll be holding another webinar in the next little while. If there are any updates, then we'll be publicising that as well. But in the meantime, if you have any questions, just go to taxready.ae and for a free call with one of our team. Thanks a lot.